invest in real estate for a variety of reasons, often because they want to be able to save for retirement or create a nest egg for their family. However, many lack a clear strategy to get themselves there, or a concrete goal to know when all the hard work is finally done. Mind you, if done correctly, your real estate investments could have you living off passive income for the rest of your life, not just the money in your bank account. I mean, we've all seen the infamous chart from your traditional financial advisor showing you the point at which you run out of money. I don't want to ever be there, and it's likely you don't either. The first step to having enough for retirement is figuring out how much you need. By working backwards, you'll create a clear path that identifies how many properties you'll likely need and when you'll have to have them paid off by. For example, let's say you want $10,000 a month starting at age 65, and you're 30 years old today. If you were willing to move every year, you could put, 0% down on your first house, 3.5% down on an FHA loan, followed by 5% down, maybe a fourth house, 5% down, and maybe 10% down on your fifth house. I mean, if you think about it, this easy strategy, moving once a year, gives you 5 entry-level homes, all purchased by the time you're 35 years old. And if I use conservative appreciation, inflation, and rent increases, this could result in a conservative $1.5 million in net worth and that $10,000 a month in income you were looking for in retirement. And it all started with 0% down. There's even more flexibility when you start looking at the multi-units, duplexes, triplexes, quadplexes, because while you move into one unit, the other units are helping you pay down the mortgage, providing multiple streams of income. This could not only mean moving less, maybe only 2 or 3 times to acquire the same number of doors, but also can safely guard you against vacancy. Because if you price the rents right, 2 or 3 could cover that last unit and account for any loss of tenants. Of course, the younger you start this journey, the more advantageous. But it's not checkmate if you start in your 40s or 50s. I didn't start investing until I was 41 years old. When you're younger, you're more likely to be willing to move to acquire each property. By moving into the property, yes, you get to finance it as a primary home, saving you on the down payment and the interest rate. Doing this can also make the process easier in some ways, but harder in others. I mean, if you're young and single, it's a no-brainer. But if you're married with 4 kids, it might not be ideal. But I've had clients who are willing to do whatever it took, even just for a few years, to get them to where they wanted to go long term. Having an end goal and having a clear roadmap was the game changer for them. So I know that this is a lot of information to consider when it comes to real estate investing. But if you're ready to jump in or simply want to learn more, please join us. We've got Building an Investment Empire this week, and I'd love to see you there and answer your individual questions on how to start building your path to the kind of financial stability that you want in retirement. Nicole Rueth, the Rueth team of Fairway Mortgage. I look forward to serving you.